Let's talk about the markets in 3 minutes. And you mentioned that perhaps the stock market is a bit of an outlier, responding to yesterday's moves, the Asia session this is, responding to yesterday's moves in the US. I wonder how significant those moves were, though, in the US. Was this just more of the same, essentially noting strength of the US consumer and therefore rates can stay higher for longer? Or was there some new dynamic? Was this just another piece of strong data out of the US? Or did it add anything new to our understanding of the strengths?
I don't think it added any new, but the price action's getting quite worrying. I think that was the 8th day in 11 that the S&P 500 has fell, and really August has turned a lot more negative in terms of the price action. There's a dynamic that is becoming global. UK shows it this morning. We saw it out in Canada CPI yesterday. We saw it at the US retail sales yesterday. That monetary policy in most developed markets does not appear to be tight enough yet to cause enough of a slowdown to quell inflation. And inflation is proving stickier, particularly in components like shelter or wages. And that means unless we cause a further slowdown, we're going to reaccelerate the inflation bubble. And this is after we've had a whole year of almost all our markets guests wanting to buy duration. People are starting to realize that maybe that's the wrong trade. Maybe it's premature. We're only at the early stages of kind of turning this aircraft carrier of thinking. But people are starting to open up to the idea that, hey, we may not be the end of the cycle for rate hikes generally. We may be too early in that theme. And that is why equity markets seem to be having a worse kind of price action. That said, I don't think the peak of the year of US stocks is in quite yet. I think we can still go higher again in the coming weeks.
OK, that's interesting. Yeah, it's fascinating how central banks are still talking about being tough on inflation, and yet you're talking about whether we've reached the end of the disinflationary phase. These two conversations that seem at odds with each other but running in parallel and causing quite some confusion. I suppose on the UK side, if we focus in on that CPI number coming in just a little hotter than had been expected. And just like yesterday, we see this knee-jerk reaction higher in the pound. And then I wonder whether, just like yesterday, we get some in the market questioning whether that lasts because of the risks to the UK economy. What do you think is at stake here?
I think we're going to see the Bank of England hike several times more. And you know, people have all year have been trying to play, for more than probably a year, have been trying to play this idea that the Bank of England can't hike too much. If they do, they'll collapse the economy. That's probably ultimately correct. I just wonder whether the timeline will take longer to play out than we still think. So we've continuously got this timing wrong for when the economy feels the crunch. And what the dynamic we're seeing everywhere, and US retail sales shows this, is that the consumer continues to be strong and resilient. There's two dynamics to that. One is the consumer was really, really wealthy 18 months ago because they got pumped money in the stimulus. Liquidity got pumped into the system. Assets were at a record high. The other dynamic is a generation has learned you keep on buying the dip, you keep on spending, and you use your credit card because central banks will have your back. But maybe this time they might not be able to afford to have your back. And that's why it could be very problematic, but why the downturn is coming later than many people have predicted.